Hello and welcome to the Elevate Your Business Summit. I am Brittany Brown, and today my presentation is on 6 ways to keep cash flow pumping inside your business. So I am the founder and CEO of a company called Ledger Gurus. I have a master's in accounting from BYU, and I am a CPA, and I've acted as a CFO, and I'm now CEO and founder of my own business. So I definitely relate to you guys. I'm assuming that most of the attendees to this summit are business owners like I am. And I understand what that feels like. I understand the triumphs, I understand the stresses. I'm pretty passionate about the accounting side of business. In fact, I have a personality that's not typically that you would find in a normal accountant. I tend to be a lot more outgoing than most accountants go, a lot more interested in interaction. But for me, accounting is truly the language of business. And by speaking accounting, it allows me to decipher what's really happening behind the scenes in a business. If I can look at a business's financial statements, I can really identify where they're making money, where they're losing money. And it's a very powerful skill to have, and it's something that I really want all business owners to be able to harness the power of what their accounting is telling them, where their finances are telling them, and to be able to get ahead of some of the most difficult aspects of business, which circle around accounting. So when people ask me what Ledger Gurus does, I tell them that we are an outsourced accounting solution for other companies. So basically, if you think about a company that's really growing and really starting to go somewhere, they typically have their staff accountant who sits at a desk somewhere, and that staff accountant is collecting receipts and bills and invoices from the various activities of the businesses, and they're pushing it through, and they're putting the information into QuickBooks or Xero or NetSuite or whatever system it is that they may be using. So our goal at Ledger Gurus is to become a very cost-effective solution, everything from bookkeeping, controller, and CFO services. So what makes us unique, though, is we've really broken the mold of the brick-and-mortar accounting firm. Our goal really is to turn accounting on its head. And we are a very, very technology-driven company. So in this day and age, there's a lot of tools that are available in this space in the cloud. Not only have typical desktop solutions like QuickBooks moved to the cloud, but you also have things like Xero and NetSuite and other solutions like that. But on top of that, you also have a whole world full of tools that are all designed to solve some sort of financial problem that a client faces. Things from managing their cash flow more effectively, being able to project cash flow, facilitating bill payment without having to be in the office, really agile and cost-effective payroll solutions, budgeting tools, expense management tools, cap table management tools, all of these tools that have really kind of taken the world by storm in the last decade, that have now made it entirely possible for an accountant to do absolutely everything they need to do, no longer sitting at a desk in your office, but in the cloud, where they can be more flexible, more agile, more efficient, and better at what they're doing. So in this world where we have really embraced the apps of the trades and in the accounting space, it's made us a particularly good fit for clients that I would categorize as e-commerce clients. Now, an e-commerce client, I would say, is any company that's selling a product online. And one of the reasons why we're a particularly good fit for e-commerce companies is because these companies face a lot of complexities around accounting issues that are not yet satisfactorily solved simply by tools alone. So because the e-commerce company is typically selling on a lot of different channels, maybe they're selling on Amazon and eBay and Jet, and maybe they have their own website that's selling on a platform like Shopify or WooCommerce or BigCommerce, and all of these different platforms are all selling simultaneously. So you have issues like, how do I update my inventory in real time? If I sell my last 10 items on Amazon, how do I immediately let my website know that I've sold out so that I don't oversell? And things like, when I'm working with Amazon, I see my deposit come into the bank account, but that deposit that's come into the bank account is net a whole lot of other stuff that's happened. It's not taking into account the total revenue minus the discounts and the refunds and the chargebacks and all the other things that happen. And in order to correctly capture all that data, it requires a significant understanding of all the different pieces and how they're coming together. Not to mention that the most difficult piece of what e-commerce clients face is how to correctly capture the cost of goods sold on the products that they're selling so that they can see their margins and make good business decisions based on accurate data when they are buying and selling, running campaigns, increasing their marketing. Those types of decisions really require a strong understanding of your cost of goods sold and how you're doing as a business. And that is not a problem that's easy to solve. So, because we've really mastered the technology of this world, we've gotten much better at living in this space. Every business's financial picture and systems and flow will be entirely different from another one. And it's important that you, as a business owner, figure out how to correctly capture the data, because nothing is more misleading than financial statements that are painting a picture that is not true. So I think every business owner relates to the fear of the cash crisis. And these sometimes can just come out of nowhere. In fact, we have a very successful client right now who is an e-commerce company doing many millions of dollars a year in baby accessories online. And they recently had a pretty big cash crisis. This was just before we got involved with them and started kind of helping them plan for these things. But around this time of year, they prepare for a lot of holiday sales. And this last year, they're anticipating a lot more volume than normal. So they had to kind of pre-order a whole bunch of raw materials so that they could get the product ready in time to sell it. So even though they do many hundreds of thousands of dollars a year in profit, they still have these periods of time, in their case because of seasonality, where suddenly they run out of cash. So picture this: basically you're a business doing very well and you're closing deals and you're selling product, but you've been so busy that maybe you have neglected to stay on top of cash collections. Maybe you're selling a service or something where you're invoicing your customers. And suddenly you realize that you have to make payroll at the end of the week, but you're $20,000 short on that payroll payment that has to go out. And now what are you going to do? And how do you avoid having this kind of thing happen? A lot of what helps business owners avoid the cash crisis is a strong understanding of how cash moves through their business and what the different levers are that they can use as a business owner. So this is kind of a simple sample of a basic cash flow cycle. So the first thing I do is I sell whatever it is I'm selling, possibly product, possibly service. And in the case of situations where I'm not being paid right away, let's use the e-commerce company as an example. Sometimes you're going to have product, oftentimes, that you do sell right away. If you're selling on Amazon or you're selling off your website, typically the customer who comes to buy from you actually makes payment at the time of sale, so it's a fairly immediate transaction. But other times maybe you're selling to wholesalers who are then turning around and selling your product. So you're having to send out you're sending out product and you're invoicing the customer, and maybe you're giving them some kind of terms like 30 days or 45 days or something like that. So now you're floating this money and you're waiting for them to pay you, and they don't always pay you when the bills due. So now you're having to wait until the cash comes in. All the meanwhile, you have bills from your vendors, your suppliers, and the terms that are running out on your things, and you're having to try to juggle this. All the while, you're having to buy more inventory to make sure that you have more product to sell, and the cycle goes on and on and on and on and on. This juggle between cash. Now, is it possible for a company to be wildly successful, very profitable, and still go out of business? And I would say absolutely that's possible. And the way that happens is there's a big difference between revenue, which is just the money that I'm owed or that I've earned from selling my product or my services, and actually having cash in the bank. If I'm not collecting that cash, it doesn't even matter if I made $1 million in profit. If I was never able to actually get that cash in the door, then the chances of me going out of business before I can get that money collected are very high. So here's a little bit more built out version of the typical cash cycle for, I'm going to use, this would be an example of like a retail company or manufacturing, or like I said, e-commerce. So you start with cash and you use that cash to buy raw materials, and then those raw materials have to be used to produce what then becomes finished inventory. That finished inventory is then sold, but you may not collect on it right away, so then you have to turn that accounts receivable into cash again. And this goes around and around and around, and it's this never-ending cycle of use your cash to buy raw materials, to have something to sell, and then collect on the money you sold. And if you're not careful, this cycle can really start to eat your lunch. So one just very basic cash flow management principle is that in general, you try to expedite the receipt of cash whenever you can. So if you have accounts receivable, there's all kinds of things you can do to kind of reduce the cycle on getting that collected. And we're going to talk about that in a few minutes, a little bit later on in this webinar. And the other thing you can do is you can delay the payment of cash. So if you have vendors that are giving you terms, if you're able to buy things on credit card instead of a debit card, anything that you can do to delay the payment of cash and speed up the receipt of cash, you're already going the right direction. But let's get into 7 very specific ways that you can increase your cash flow. So the first one we're going to talk about is price. And we're going to talk about price and sales because these are the things that people most typically think of when they are trying to fix their cash position. So we're going to get these two out of the way right away. So price is this kind of tricky thing because you can increase your cash strength by increasing your price. But even within that world, there's certain parameters that you have to live within. So whenever I'm consulting with a client on how they should price their product, there's really 2 things that we talk about. We talk about the price ceiling and we talk about the price floor. Now the price ceiling is really kind of like a market research question, like what will the market bear if I raise my price? How many of my customers will I lose? Surprisingly enough, you can often make more money by raising your price, even if you lose some of your customers. Just a simple, straightforward example of this would be that if I have 4 customers and they're each paying $50 an item and I'm making $200, and I decide instead to raise my price to $75, and when I raise my price to $75, maybe one of my customers says, or 25% of my customers say, that's too much for me, I'm not going to buy that anymore, but the other 75% of my customers are willing to pay the higher price. I make $225 now instead of $200, and I had to produce less product to do it, so even my costs were lower as well. So my margins got better, my level of work decreased, but my revenues and my profits and my cash ended up increasing instead. So the ceiling price is really a question of what market will bear. I would say more often than not, people price their product too low. They have customers that would be happy to pay a higher price for whatever it is they're selling, and they don't realize that, and they don't take advantage of it. Perhaps an even more important aspect of pricing to consider is this floor pricing. Now, the floor pricing is really a matter of understanding your costs of your product. Now, you definitely should never price a product for lower than it would cost you to produce and sell that product, or else you're basically guaranteed to lose money. So if I have a product that costs me $100 to produce, and when we talk about producing, we're talking about all the direct costs that go into producing a product, which we're going to go into a little bit more depth in just a few moments. But basically, if it costs me $100 to purchase a widget, then I definitely don't want to sell that widget for less than $100. But it's not always that straightforward, and it's not always that easy to just see that I'm paying $100 for a widget, because even in the case where I'm buying a widget and it's already pre-made, even then there's things to consider, like how much did it cost me to have that item shipped to me? Did I have to pay some sort of commission when I sold the product? Do I have hidden fees like warranty costs or other things that are associated with my cost of that product? So the second lever you can pull with increasing your cash flow is to sell more. Now, this is really a marketing exercise, like how can I build awareness? How can I market more? I know there are people as part of the summit who really specialize in the marketing aspect of running your business, and they're really worth their weight in gold, because a really effective marketer that can drive sales to your business can really affect the profitability and the cash position in every way. So selling more, obviously a good thing for cash. So another way that you can improve your cash position is to cut your COGS. Now, COGS stands for cost of goods sold. And we talked a little bit about this a minute ago when we talked about pricing. So cost of goods sold is a specific type of expense category that relates to all the very specific costs that go into producing or selling a product. So this would include things like the direct materials and the direct labor to produce a widget. It also might include things like a foreman's salary, it like machine hours if you're using machines to produce parts, packaging, different things like that. So I'm an accounting firm, and what I sell is people's time. So my people's time is my inventory. And so my cost of goods sold for my company is the amount of money that I pay my employees to perform accounting work, basically. So I can cut my cost of goods sold as a way to improve my cash position. So some of the ways that I can do this is I can buy in bulk. I can take advantage of payment terms to get a discount for early payment. I can find a new vendor that gives me better pricing. I can outsource the manufacturing of something. I can in-house the manufacturing of something. I can change the structure of it. I can change the way I'm packaging things. I can, if I'm doing services, I can maybe use interns. Maybe change the structure of having like a lower level employee who's being trained by high level employee, so the cost of that employee goes down. There's all kinds of options I can do when it's cutting costs. You just kind of have to think creatively and think outside the box. So the next way that you can increase cash flow, and I think we're on number 4, I should have numbered these, is you can cut overhead. Now, overhead are all of the costs of your business that are not the COGS, so not the direct costs. These would include things like the rent of the building, the salaries of your general and administrative staff, marketing expenses, traveling expenses, utilities. So many of these costs are fairly fixed in the short run. Rent, for example, I'd have to move buildings if I wanted to decrease my rent, or I'd have to lay somebody off if I wanted to decrease my salaries. But these costs are never fixed in the long run. And a savvy business owner should always be evaluating costs and whether or not those costs are serving them. So one of the factors we look at, one of the KPIs that we evaluate for our clients is something called a return on labor. So we'll say, like, how much money are you making in profit per dollar you're spending in labor? And as you start to watch that ratio move up or down, you can start to see that maybe you're being less effective with the employees that you have, or maybe the employees you have are being more effective. But one way or the other, it's definitely the kind of thing you should be watching. So number 5, a way to increase cash flow is to better management of AR. Now, this one's a really, really big one. This is probably one of the biggest ones we see do clients in. We have a client right now that they had a bad accounting department for for a couple years before they decided to outsource it to us. And during that period of time, their staff accountant literally lost a track of about $1 million worth of receivables. Now, a year later, our ability to go back and collect on those receivables is substantially lower than it would have been had he been on top of it to begin with. So first of all, it's really staying on top of your receivables and really understanding who owes you what. And the second thing is to really decrease the amount of time it's taking to turn those receivables around. Now, we talked about that cash cycle and how it goes from, you make the sell to it becomes an accounts receivable till it turns into cash. And that cycle is called an accounts receivable turnover. And it's another thing that could be calculated. I put the formula right up here. This will actually give you a ratio that will show you how often during a year you're turning over your receivables. So basically, the higher this number, the better off you're doing. So if this number is, say, like a 2 or a 3, it means you're only turning over all of your receivables and turning them into cash 2 or 3 times a year on a cycle. Whereas if you can increase that to 15 to 20, then it means that you're rotating through that cycle much more rapidly in a given year or a given period of time, whatever it is you're measuring. So reducing that turnover ratio is an effective way to improve your cash dramatically. So some of the things you can do to improve your accounts receivable turnover is you can make it easier and faster for your clients to pay you. So everything you can do to reduce the time or to reduce a step will decrease that cycle. So for example, I know that most of the online accounting solutions today, like QuickBooks Online and Xero, They actually offer you the ability to allow your clients to pay you online. So you send out an invoice with a link on it that will allow your clients to pay you directly from the invoice that you email to them. And that's really valuable because if your client's able to just pull up the invoice and put in a credit card or a bank account number right then and there, then you get paid immediately versus the old-fashioned way where somebody takes an invoice, they print it out, they mail it out to their clients, they have to wait for the client to sort through the mail, cut a check, stick it in the envelope, stamp the envelope, mail it back. That whole cycle can take, weeks, honestly, versus the emailing out the invoice with a link right in it, which is something they can pay right away. So that's just one example of how you can decrease your AR cycle and increase your cash flow. So another one is your inventory. So having a faster inventory turnover. So if I'm, yet again, like an e-commerce company and I have a pile of inventory sitting in my store, like that is money. That's a lot of money. And the longer it sits there, the more likely it is to become obsolete and the more value it loses. So the faster I can turn that inventory around, the better off I'll be from a cash perspective. Not only do I have a lot of money tied up in inventory, but we talked about some of the risks of just holding inventory. So some of the ways that you can turn your inventory over faster are things like increasing sales, but also things like not bulking up to begin with. So I remember when I was in business school, the thing that was kind of the big popular thing of the day was this just-in-time ordering system where companies were really moving away from buying big warehouses full of inventory and sitting on it to a much more agile approach of only buying inventory, giving themselves a couple day leadway instead of weeks or months. So turning your inventory over faster can be a matter of both selling what inventory you have faster and also not investing as much in the stockpile to begin with and ordering smaller quantities more often. Incidentally, there's also a inventory turnover ratio that will allow you to kind of measure how well you're doing on inventory turnover. But we're going to get into that right this second. So finally, number 7 is that you can increase your AP. So this is where I talked about like taking advantage of terms and allowing vendors that allow for payment terms to stretch that out just a little bit. So holding on to the money that you have and not just paying bills the minute you get them, but to instead be more strategic about saying, I'm going to hold off on paying this bill and I'm going to pay this bill instead, or I'm going to, wait the 30-day period to pay this bill so that I keep more cash in the bank. So in wrapping up this presentation, let's talk about you as the business owner and the role you're playing in your own accounting. So obviously every single business, whether even if it's just for tax purposes, but more importantly so the business owner can manage their business effectively and proactively, somebody has to be doing the accounting. So one of the options is that the business owner becomes the accountant. I mean, this is probably one of the most common things we see. It's painful for the business owner, not a super great use of their time. The other option they have is to hire a cheap bookkeeper. But typically, these bookkeepers are just good at routine tasks. They have to be managed, though. They only really address the basics. They won't grow with the business, and typically you get what you pay for. So great option for a small business doing simple things, but not a great option as a business starts to grow and get bigger. This is where companies often think that the jump is from, a cheap bookkeeper to feeling like they have to hire a full-time staff. This may be a full-time bookkeeper. It may be a full-time accountant. They may have to go right to full-time CFO because they know that the complexity of what they need is greater than what they are getting maybe with the bookkeeper or trying to do it themselves. But the full-time staff accountant option is like a huge jump and it's unnecessary. But often companies do this because they don't know that they have another option, which is what I'm going to call the ledger gears approach. So what we do is we take your accounting department that's full of a whole bunch of individuals, and we basically create what I call a fractional solution, where we say, your bookkeeping only takes 10 hours a week, and then you need maybe 2 or 3 hours a week of a CFO's time to oversee it. And we marry those two things together so that you have a complete solution. One of the things that makes us really unique is that we combine an understanding of the transactions with an understanding of the processes to engineer and optimize flow of all accounting functions. So we're not just bookkeepers and we're not, just the higher level overpaid CFOs doing bookkeeping work, but we actually have both people engaged on an engagement, and we are really shooting for an optimized flow. We're using the systems, we're using the technology, we're automating whenever we possibly can. We are very, very often able to take an engagement that had a full-time accountant on it and handle all of the accounting needs for that company for a fraction of the cost of what they were paying a full-time accountant, because we are so good at using the tools to automate the flow of all of that. Although there are lots of different industries that we're willing to help and support, clients that are a particular good fit for us, or rather I should say, clients that we are a particularly good fit for, are clients that are in the e-commerce space. And the reason why this is so is because of all of the different industries we've worked with, this is the industry where it is most likely that a bookkeeper does not understand the complexities of the space and is not correctly capturing financial information. So in particular in the e-commerce space, we're able to have a huge impact on the correctness of the client's financial accounting system with a high degree of automation, keeping the cost significantly lower than they would pay for in-house staff, while giving them a much better result than they would often get by using someone who didn't specialize in this space. A client that we're an ideal fit for is a client that's selling online, typically on Amazon, maybe a website built on Shopify or WooCommerce, and doing over $500,000 a year in revenue. If this is you, we do have a special offering for these clients as part of this webinar. We do a financial analyst and e-commerce profiling, which goes through all of the systems that you're currently using, talking about the complexities within that system, holes in your current solution set, and market solutions that are available to kind of plug some of the areas where you're struggling, and do a free proposal and analysis if you chose to have Ledger Guru's help. But mostly this profiling process is for your benefit. This is normally something we charge $297 for. It usually takes anywhere from 1 to 2 hours. But as part of this webinar, we're offering this for $99 if you contact us before the end of the year. So this is my contact information, bbrown@ledgergurus.com, 801-735-6521, and thanks for participating in this webinar.